Welcome back to the Multifamily Deep Dive by Bridgewater Realty Advisors, the multifamily experts in South Louisiana, Mississippi, and Alabama. Today, we're going to get right to it. We're not going to mince words because we're talking about what is probably the single greatest self-inflicted wound an owner can sustain when they decide to sell their property.
It's choosing the wrong person for the job, a generalist instead of a specialist.
Exactly. And it's a huge deal. I mean, this is the culmination of years, maybe decades, of work and risk.
It really is. It represents the highest of stakes. And yet, so often, that final critical decision is driven by, well, by emotion, loyalty, or just convenience.
Right. I want to set the stage for you, the listener, right away with a quick analogy. Just think about this for a second. If you needed open heart surgery, I mean, a procedure that literally determines your future, would you use your general practitioner?
Of course not.
Would you pick the person who handles your annual physical just because you like them and you've known them for years?
No, you want the surgeon. You want the person who does nothing but that all day, every day. Specialization is, it's non-negotiable when your life is on the line.
Okay. Or what about this one? Your entire family's financial future is hanging on a complex court case. A multi-million-dollar dispute.
Yeah.
Are you going to hire the lawyer who, does some law on the side but mostly handles traffic tickets?
Absolutely not. You're hiring the litigation expert, the specialist.
So this is the core conflict we're diving into today. Why on earth, when you're facing the sale of a multi-million-dollar multifamily asset, often the largest financial decision a family will ever make, do owners hand the keys over to someone who doesn't specialize?
They choose comfort over competence every single time.
Yeah.
The friend, the family member, over the actual financial engineer who can maximize the outcome.
And that really is the thesis for this whole deep dive, isn't it?
It is. It's simple, and it's maybe a little brutal, but it's true. Selling a multifamily property is not a test of friendship. It's not a favor.
It's a transaction.
It is a highly complex financial transaction it has permanent, unavoidable impacts on your wealth, your retirement, your family's future. This whole deep dive is about why specialization isn't just a good idea, it's mandatory.
Okay, so let's unpack the psychology of that first. Because it's a very human thing to do, right? We choose what's familiar, we trust people we know.
It's completely natural.
We feel this sense of loyalty, especially if it's someone who, maybe helped you buy your first house 20 years ago. But we have to get real here. When the number of zeros on that transaction jumps into the millions, that same human tendency becomes a massive financial vulnerability.
It's a paradox, really. You work for decades to build this incredible asset, and then you put it all at risk at the finish line because you're trying to manage feelings instead of finance. We hear the same reasons every single day.
And they sound so harmless, don't they?
Yeah.
So innocent, but they're loaded with financial risk. What are those common reasons you hear?
The list is, it's short and it's predictable, and it almost always costs the seller a lot of money. The first one is, well, they helped us buy our house years ago. They're a great agent.
Right.
But selling a single-family home and selling an income-producing apartment building, they share a roof and a foundation, and that's about it. The financial mechanics are completely different worlds.
What's next on the list?
They're a close friend or a family member, and I feel like I have to give them the business. That's the loyalty trap.
The obligation.
Yes. The desire to keep the relationship smooth overrides the fiduciary responsibility you have to the asset and to your family.
And then there's the one that's maybe the hardest to argue with.
They're just a genuinely good person. And look, we don't doubt that for a second. But good intentions don't equal sophisticated financial expertise. You need capability, not just character, when you're dealing with a deal of this size.
And what's the absolute worst one? The one that's just a complete misunderstanding of the business.
It's the false belief that, hey, they're licensed, so how different can it be? The idea that a state license makes you competent in every asset class is, frankly, it's absurd. A driver's license lets you drive a car, right? It doesn't mean you're qualified to fly a 747. The license is just the starting line. It's not a seal of expertise.
That's a critical distinction. So you can like them as a person, you can admire their character, but that doesn't make them the right person to handle this.
Not at all. You have to separate the person from the professional function. Liking someone is completely different from trusting them with the transaction that's going to fund the rest of your life.
So that loyalty, as admirable as it is in our personal lives, it becomes a liability here.
A massive one. If that loyalty costs your family 6 or even 7 figures in lost equity, or worse, if it blows up a critical 1031 exchange timeline, it stops being admirable. It's just a bad business decision.
And the generalists, they often want to do a good job, right?
Yeah.
They're not malicious.
No, of course not. They have the best intentions. But good intentions cannot make up for a lack of specialized asset-level knowledge. It's like showing up to a Formula One race with a really, really nice Toyota Camry.
Right. It's a great car, but you're in the wrong race.
You're in the wrong race. You don't have the engine, you don't have the aerodynamics, you don't have the pit crew. You can't execute at that level.
So before we get into the nuts and bolts of what a specialist actually does, there's one key line we need to internalize.
Yes. Every listener needs to hear this and really let it sink in. It's simple. You don't owe anyone access to your financial future.
Say that again?
You do not owe anyone access to your financial future. You earned that future through years of risk and hard work. Protecting it means you have to prioritize expertise over everything else.
Okay, so let's unpack that. If we strip out all the emotion, all the loyalty, and just focus on pure execution.
Yeah.
What are the specific, measurable things that a specialist delivers that a generalist just can't?
This is where the rubber really meets the road. And frankly, it's why Bridgewater Realty Advisors is the leader in multifamily sales in the region, because we are on top of all these data points for our clients.
So what's the framework?
We break it down into 3 pillars of value creation. The generalist looks at the surface. The specialist understands the deep financial architecture of the asset.
Let's start with pillar 1. What is it?
Pillar 1 is asset-level financial engineering.
Okay, financial engineering. That sounds complex. The generalist method is pretty simple, right? Pull some comps, slap a price on it, and wait for the phone to ring.
It's a hope-based strategy. And it fails because commercial property value isn't based on what the building next door sold for. It's determined with surgical precision by the income it produces.
So the specialist's job is different from the start.
Completely. Our first job is to manufacture a sophisticated, defensible, and compelling value proposition based on the numbers. We're telling an investment story that the most sophisticated buyers in the world will compete for.
So walk us through that. Where does it start?
It all starts with net operating income, or NOI. This is the foundation. It's all the revenue minus all the reasonable operating expenses. But crucially, that's before you factor in debt payments or big capital projects.
And a generalist might just look at the top-line revenue.
Right. A specialist doesn't just list the revenue. We rigorously underwrite the NOI. We scrutinize every single dollar coming in and going out to find the asset's true, stabilized earning power.
That word underwrite sounds important. It's more than just reporting the numbers.
It's about adjusting them. This leads to the next step, normalizing expenses. This is where a generalist gets lost immediately, and it can cost a seller hundreds of thousands of dollars.
What's an example of normalizing an expense?
Okay, say an owner-operator pays themselves a $100,000 salary for property management.
Which is way above market rate.
Exactly. A third-party firm would charge, say, $50,000. A sophisticated buyer is going to see that inflated expense, adjust it down in their own model, and lower their offer price.
So the specialist fixes that up front.
We adjust it on day one. We normalize that management fee to the market rate of $50,000. By cutting that one expense line in half, we instantly boost the NOI. And a higher NOI means a higher valuation, period.
What's another big one you see?
Taxes and insurance. Maybe property taxes spiked last year because of a one-time reassessment, or insurance was crazy high because of a storm. A generalist just lists that high number and it drags down the NOI.
But it's not a recurring cost.
Precisely. The specialist removes that one-time hit, or maybe uses a 3-year average to show the stabilized, predictable expense. That one adjustment, let's say it adds $50,000 back to the NOI if the market cap rate is 5.5%. That one change just added over $900,000 to the property's value.
Wow. Just from one single accounting adjustment, it's literally creating value on paper before it even goes to market.
We're not creating it out of thin air. We're revealing the value that's already there, but it's hidden by inefficient operations. We also look at things like implementing a RUBS program, a ratio utility billing system.
So billing tenants back for water and trash instead of the owner eating that cost.
Exactly. We underwrite the property as if that system is already in place. We show what the expense line will look like post-acquisition. It's another massive boost to the NOI.
So this is all about presenting the asset's true defensible earning potential.
That's it. And it brings us to the core of any institutional sale, the difference between pro forma versus trailing income.
Trailing is what it did do. Pro forma is what it could do.
You've got it. Trailing is the documented history. Pro forma is the credible roadmap for the future. If rents are currently $900, but we know the market can bear $1,100 with some minor upgrades, we don't just sell it based on the $900.
Maybe sell the plan.
We create a justified pro forma that shows the buyer the path to that future cash flow. We detail the budget, the timeline, everything. It justifies a much higher price today because you're not just buying a property, you're buying a proven value add opportunity.
So you're basically doing the buyer's homework for them, but framing it to maximize the seller's price.
That's a perfect way to put it. And we go one level deeper into a metric most generalists don't even understand: the debt service coverage ratio, or DSCR.
That's what the bank cares about.
It's life and death for the deal. It's the property's ability to pay its mortgage. If we can underwrite the NOI to ensure a healthy DSCR, say 1.25 or higher, it means the property is easily financeable.
Which means more buyers can compete for it.
And that drives up the price. A generalist might price an asset so high that the DSCR doesn't work for any lender, making it impossible for an institutional buyer to even make an offer.
It's a completely different level of thinking. It's financial engineering versus just listing a property.
And that brings us to pillar 2, buyer pool control. Because a lot of sellers think the goal is just exposure.
Yeah, I hear it all the time. Just get it out there. Put it on LoopNet. Put it everywhere. I want eyeballs.
That's the classic generalist mistake. They cast a wide net and hope for the best. The specialist strategy is the opposite. It's surgical, it's targeted, and it's designed to create competition and artificial scarcity.
So how do you control the buyer pool to do that?
It starts with something you can't just buy: active investor databases. And I don't mean just a mailing list.
Yeah.
I mean a constantly updated, detailed database of qualified buyers segmented by their exact criteria: asset size, geography, capital structure, and most importantly, their current motivation.
So you know who is looking for this exact type of property right now.
Today, this afternoon. It means we're not broadcasting to the world. We're hand-delivering the opportunity to the 10 or 15 buyers most likely to close at the highest price.
But saves a ton of time vetting people who are just kicking tires.
Wasted time is wasted money. And we take that a step further by understanding investor pressure. We know the buyers' why, what's driving them. For example, we know exactly which buyers are under intense 1031 exchange pressure.
Okay, for anyone listening who isn't familiar, break down why a 1031 is such a powerful motivator.
A 1031 exchange lets an investor defer capital gains taxes by rolling the proceeds from a sale into a new property. But they're on a very tight clock. They only have 45 days to identify a replacement property and 180 days total to close.
And if they miss that deadline?
They get hit with a massive tax bill, potentially millions of dollars. So a specialist knows who in their database is on day 120 of their 180-day window and getting desperate.
So you can approach them with a solution.
We can go to that buyer with a pre-underwritten, clean asset and say, here's your solution, but you need to act now. That urgency creates more aggressive offers and cleaner terms than any public listing ever could. And that laser focus is exactly why Bridgewater Realty Advisors is the leader in multifamily sales in the region, because we are on top of all these data points for our clients.
You're shifting the power dynamic. You're not waiting for offers. You're creating a competitive environment.
We are creating controlled competition. And this brings us back to the most important line in this section. Say it with me. Exposure doesn't create value. Competition does.
1 million views from unqualified people means nothing.
0. 10 offers from qualified, motivated buyers competing against each other under a tight deadline. That is how you maximize value, period.
It's a sealed bid auction versus a public yard sale.
Exactly. And that control maximizes the price. Which leads us to pillar 3. This is where a lot of the hidden money is.
Pillar 3 is deal structure.
Yes, this is the money that a generalist doesn't even know is on the table. They default to the simplest transaction, cash or a conventional loan.
Because it's what they know from residential deals.
It's all they know. They miss out on millions in potential value for the seller because they can't even explain, let alone execute, alternative structures.
So what's the first big one a specialist brings to the table?
Especially in a volatile interest rate market, it's seller financing. This is where the seller acts as the bank for the buyer.
Why would a seller ever want to do that? It sounds risky.
It involves managed risk for sure, but the payoffs can be huge. First, you can often get a higher sale price, maybe 5 to 10% higher in exchange for carrying the paper. Okay.
Second, the seller gets a great interest rate on that note, much better than they could get from a bank. It turns them from an active operator into a passive lender with a steady, high-yield income stream. And there are massive tax advantages, too, because the gain is spread out over years.
That's a high-level wealth strategy, not just a property sale. What else is in the toolkit?
We use things like master leases and earnouts. These are designed to bridge valuation gaps.
Okay, explain an earnout.
Let's say you, the seller, think the property is worth $10 million based on future rent growth. But the buyer's model, based on today's numbers, only supports $9 million. That $1 million gap kills the deal for a generalist.
So how do you solve it?
We can structure an earnout. The buyer pays $9 million today, but agrees to pay you, say, another $1 million if and when the property hits certain performance targets over the next 2 years.
That's brilliant. It lets the seller get their price if they're right, and the buyer only pays for performance once it's actually delivered. It aligns everyone's interests. But it requires sophisticated legal and financial structuring that is way beyond a generalist's ability. And finally, there's expertise in assumptions and tax consequences.
Assuming an old loan with a great low rate.
Exactly. That can be hugely valuable to a buyer. And we're also deeply aware of the timing of the sale. We work with the seller's CPA to make sure the closing date doesn't create an unnecessary tax nightmare. We look at the net proceeds after tax, not just the sticker price.
The bottom line is, generalists leave money on the table. They force a complex deal into a simple box because it's the only box they have.
And that's a perfect transition to our next point, because that lack of sophistication doesn't just cost money, it costs time. And in this business, time is the enemy.
Time kills deals. I've heard that phrase 1,000 times. Multifamily deals are so sensitive to outside factors. Every day on the market is a day you're exposed to risk.
Compound risk. When a generalist takes 4, 5, 6 months to get a deal done, they're forcing the seller to gamble on things they have zero control over.
What's the biggest external risk?
Without a doubt, it's interest rates. Interest rates move. And a small move can have a catastrophic impact on a deal. A 0.5% hike can completely crater a buyer's valuation overnight.
Walk me through how that happens.
Okay, a buyer underwrites a $15 million deal with $10 million in debt at a 6% interest rate. Your generalist takes 4 months, and during that time, rates go up to 6.5%.
So the buyer's mortgage payment just got more expensive.
A lot more expensive.
Yeah.
And that crushes their debt service coverage ratio, the DSCR we talked about. The lender now says the deal doesn't work. The buyer has 2 choices: walk away or come back to you and demand a massive price reduction to make the numbers work again.
So that 4-month delay just cost the seller maybe $1 million.
At least. You're also exposed to shifts in the broader market. Market cycles shift. Investor sentiment can turn on a dime. And just as importantly, momentum dies. A deal that sits on the market for months gets a stigma. People start to wonder what's wrong with it.
So how do generals specifically waste all this critical time?
2 classic mistakes. First, they overprice it and then have to do price cuts. They list it too high to make the seller happy, get no action for 3 months, and then have to slowly chase the market down. That signals desperation to every serious buyer out there.
They're telling the market we don't know what we're doing.
Exactly. The second sin is mismanaging due diligence. They're reactive. They wait for the buyer to ask for documents, then they scramble. It's disorganized.
And that creates delays and frustration.
Which leads directly to the buyer demanding a retrade.
The retrade. The dreaded second negotiation after the contract is already signed.
It's a nightmare for the seller. The buyer uses the chaos of due diligence as leverage to demand a price cut. The specialist avoids all of this through timeline compression. By doing all the work up front, we price it correctly on day 1 based on real financial engineering. We market it directly to qualified, motivated buyers. And, most importantly, we pre-package the entire due diligence file before the property even hits the market.
So when a buyer is interested, everything is ready to go in a neat little package.
A verified, comprehensive digital data room. Leases, financials, reports, everything. This can cut the due diligence period from 45 days down to 20. It gives the buyer less time and less ammunition to try for a retrade.
It reduces the risk exposure dramatically.
Which is why we always say the fastest deals are usually the highest price deals. You compress the timeline, you maintain momentum, and you force the competition to act decisively. That's how you protect your price.
Okay, so let's quantify this. Let's put a real number on being nice. What does all this lack of specialization, actually cost an owner?
The tangible costs are, frankly, shocking. Based on market data, choosing a generalist over a specialist typically results in a final sale price that is 3 to 5% lower than it should be.
3 to 5%. Let's make that real. On a $10 million property, you're saying that just by choosing your friend, you are lighting $300,000 to $500,000 on fire.
That's a conservative estimate.
Yeah.
Yes, that's a retirement fund, that's a kid's college education, and that's just the hit on the price.
There's more.
Oh, yeah. You have longer carrying costs, more mortgage payments, more taxes, more headaches. You have a much higher risk of that retrade we talked about, which could be another 100 grand. More deals fall apart completely.
And what about the intangible costs? The stress?
It's immense. The anxiety, the distraction from your real business, the sleepless nights. If you're in a 1031 and a deal falls through because of incompetence, the tax consequences can be life-altering. The psychological cost is huge.
So the hard summary here is unavoidable.
It is. Being nice is expensive when you're selling income-producing property. Your fiduciary duty is to the asset and your family's future. It has to come before any perceived social obligation.
So we have to reframe this decision. It's not about being disloyal. It's about being a responsible steward of your own wealth.
That is the perfect way to put it. This sale is a critical moment. The proceeds from this one transaction, they fund your retirement, they build generational wealth, they provide the capital for your next big opportunity. You can't afford to get it wrong.
But what if you're in a situation where you feel you absolutely have to involve a friend or a relative, a sibling who's an agent, for instance? Is there a diplomatic way out?
There is. And it's the responsible adult move when business and personal relationships collide. It's called co-listing.
So you don't cut them out completely.
You don't have to. You insist that a true specialist like Bridgewater Realty Advisors, the multifamily experts, be brought on as a co-listing agent to lead the transaction.
So what are the benefits there?
Well, first, the relationship is preserved. The friend or relative still gets credit and a piece of the commission. But you immediately inject all the critical expertise we've been talking about.
The financial engineering, the buyer database, the deal structuring.
All of it. The specialist controls the process and ensures the best possible outcome. The commission gets shared, but the massive financial risk of incompetence does not.
That is a powerful concept. The risk is not shared.
And this is the thought every owner in that position needs to embrace. Egos can split commissions. Ignorance splits equity. It is far, far better to split a fee and get an extra $500,000 in your pocket than to give the whole fee to one person and lose $1 million in equity. Protect a relationship, but prioritize the asset.
Okay, to bring this all home, let's give the listener an actionable checklist, a way to pressure test any agent they're considering. What are the red flags?
Let's do a rapid fire round. Red flag number 1. You ask them how they'll price your property, and they cannot clearly explain or accurately underwrite net operating income, NOI. If they stumble on that, the conversation is over.
What's the sign they're stuck in a residential mindset?
Red flag number 2. They talk mostly about comparable sales or comps instead of cash flow. Comps are context, cash flow is value. If they lead with comps, they don't understand your asset.
How do you test their buyer network?
Ask them, who are the top 5 buyers for my specific property right now? If they have no active, verifiable relationships with qualified investors and their answer is, I'll put it online, that's a huge red flag.
What about their track record?
It needs to be specific. If they lack a demonstrable track record in your property's specific size and class, they're not a specialist. Selling a fourplex doesn't qualify you to sell a 100-unit building.
And what about understanding the other side of the table?
Red flag number 5. They cannot explain how an institutional buyer will underwrite the deal. If they can't speak the buyer's language of cap rates and DSCR, they can't possibly negotiate effectively on your behalf.
And the last one.
They actively avoid discussing complex deal structures like seller financing or earnouts. It means they don't know how to do them, and they'll limit your options to the only thing they know, costing you flexibility and money.
So the takeaway is sharp. If they can't explain these things simply, they can't control the process, and they can't get you the best outcome.
And that rigorous focus on data and execution is why Bridgewater Realty Advisors is the leader in multifamily sales in the region, because we are on top of all these data points for our clients.
So let's bring this to a final close.
I think we need to. This decision, who sells your asset, it has to be surgically removed from emotion. It is not about who you like. It is not about a favor from 20 years ago. It is purely 100% about who can protect and maximize the asset you spent a lifetime building.
When the stakes are this high, when the difference is literally hundreds of thousands of dollars, specialization isn't optional, it's mandatory. You get one shot to sell this thing for its maximum value.
And the cost of that learning curve, if you hire the wrong person, it comes directly out of your pocket. So the question we want to leave every listener with tonight is this. How much value are you currently leaving on the table, in price, in tax efficiency, in peace of mind, just to avoid one tough but necessary conversation?
If anything we talked about today raised a red flag for you, or if you just want a second opinion on your asset's true potential, we invite you to do that. Explore what your property is truly worth when a specialist underwrites it. Or if you're feeling that loyalty pressure, explore a co-listing solution.
The goal is always education first, transaction second. Knowledge protects wealth. Specialization maximizes it.
Thank you for joining us for this deep dive. We are Bridgewater Realty Advisors, the multifamily experts in South Louisiana, Mississippi, and Alabama, and we are committed to making sure expertise is the foundation of your financial future.